Good afternoon, everybody, and thank you for joining us. Welcome to this BDO webinar, Planning for Change, a pre-election discussion. My name is Tony Young, and I'm a partner in the Business Services Division of BDO, and I'm joined by my senior tax colleague, Mark Molesworth. Good afternoon, Mark.
Good afternoon, Tony.
Mark, it's just gone midday here in Brisbane, not far away from us. The City Hall tower is chiming. And I guess if the polls are right, the bells might be tolling for the current government in terms of the end of its reign. This election seems to be different from recent elections in that the parties are going to the polls with some sort of material differences in their tax policies. So today we thought we'd try and unpack those significant differences and work our way through those, because there's been a lot of speculation and hype in the media about different elements of it. So looking forward to our discussion. I guess it wouldn't be an accounting discussion or a tax discussion without a disclaimer. So all of this is going to be predicated on the fact that there will be a change of government and their ability to get cross-bench support in the Senate. So we're looking at covering the areas of businesses, individuals, and superannuation. And if we can, we might just turn to businesses. So we've selected these ones to work our way through. They're sort of the material ones. Thin capitalisation, or thin cap as it's affectionately known, that seemed to be a little out of left field.
It was, Tony. This has been a policy of the Labor Party for some time. They took this policy to the 2016 election as well. So what thin capitalisation can do is for a foreign controlled Australian entity or an Australian entity that itself controls foreign entities, the thin capitalisation provisions can limit the tax deductions for interest and other interest-like things, so bank charges and so forth, where the total debt deductions of the entity are over $2 million a year. So at the moment, if you are captured by the thin capitalisation provisions, you have three options as to how you calculate whether there is a denial of some of your interest deductions. You have the safe harbour rule, which essentially allows the Australian entity to be geared up to a 60% of the total assets of the entity can be supported by borrowings. There is an arm's length debt test in the law, which allows you to say, well, if I were a completely independent entity, what would be the maximum amount that an arm's length lender would let me have? And the third possibility is what's called the worldwide gearing test. And that worldwide gearing test says that the Australian entity is not allowed to be geared to any greater rate than the entirety of the worldwide group. The Labor Party policy is to remove those first two options. So to remove the safe harbour rule, the 60% gearing rule, and to remove the arm's length debt test, and force everybody who's captured by the thin capitalisation rules to use the worldwide gearing ratio. It's fair to say this is probably going to upset a number of multinational entities, Australian entities that are captured by the thin capitalisation rules. But when we use the term multinational entities, we're not just talking about Google and Apple and so forth. The thin capitalisation rules can apply to, as I say, any Australian entity that is foreign controlled, or any Australian entity that has foreign controlled subsidiaries overseas, So this is quite a broad ranging change. The vast majority of taxpayers in our experience are using the safe harbour rule at the moment. So they're using the 60% gearing rule. To change everybody to the worldwide gearing test is going to be quite a significant amount of administrative work for taxpayers. And I think depending on what new taxpayers take of the likelihood of a Labor victory, it might be wise to start turning their minds to what the worldwide gearing test would look like for them.
So it sounds like it's going to bring more people into the net, firstly, and the compliance costs are going to be significant.
Definitely the compliance costs are going to be significant in this change. A lot of companies that are captured by thin capitalisation at the moment have set themselves up to meet the 60% gearing test, so the safe harbour test, because it's a firm line in the sand. It's a line that businesses can plan to be at or under. The worldwide gearing test, on the other hand, varies from year to year. Very difficult to plan for. The calculations involved are considerably more complex. There's a lot of administrative work to be done here.
And the Labor Party are quoting significant savings. I think it's 1.1 billion over the next 4 years and 4.6 billion over the next 10 years.
I would be surprised if it was that small, to be honest. I would think that there is likely to be a bigger fallout than that. I think those costings that have been done, the Parliamentary Budget Office actually call them of low reliability because so few taxpayers actually use the worldwide gearing test at the moment. It's very difficult for the people who are doing those costings to know what the behavioural change will be from taxpayers, and also what the outcome would be if taxpayers were forced to move onto a worldwide gearing test.
Anything in the billions is a good policy announcement, though, isn't it?
Well, you know what they say: a billion here, a billion there. Fairly soon, we're talking about real money.
So the next issue is taxation of trusts. Now, the governments of various persuasions have been talking about the taxation of trusts since I was in short pants, which is a long time ago. Finally, this is something that they're contemplating seriously.
It is. So the proposal is that all distributions from trusts to adults will be taxed at a minimum rate of at least 30%. So that sounds really simple if you say it quickly, but there will be complexities that come out of this. Minor beneficiaries, so beneficiaries under the age of 18, are already taxed at penal rates, at the top marginal rate of tax on distributions from trusts. So they're already captured by a minimum tax rate system. It's just that the minimum tax rate is the top marginal rate. Distributions to all other adult beneficiaries being caught at 30% really changes the conversation around either businesses or investments being held in trusts, and what that means for the families of those people. I think this proposal, if implemented, may actually cause some behavioural change amongst people. There are probably a few things that might change. Currently, for people operating businesses through trusts who might be remunerating family members who work in the business but who don't necessarily draw a salary or a significant salary, and currently remunerating them through trust distributions, may begin to remunerate those people through salary and wages, because the salary and wages which are paid for genuine work will not be subject to the minimum 30% tax rate. The other thing that this minimum tax rate for distributions flowing out of trusts might cause, particularly in combination with the changes to the capital gains tax discount that I know we're going to talk about later, is that these changes make companies as investment vehicles for families actually quite a lot more attractive. And so there might be behavioural change in that way.
There's a subtle difference from receiving a dividend, though, isn't there? This will just be taxed in the hands of the beneficiary recipient, and so we'll just have more complicated calculations of tax payable at year end.
That's right. So we should stress that this does not appear to be a proposal to actually tax the trust at 30% and then allow it to pass out a fully franked dividend. The trust tax return will look much the same. It will be the effect in the individual beneficiary's tax return, where we'll have some fairly complex calculations to do to work out whether the minimum tax rate of 30% is being paid on the distribution or not.
So next we have the Australian Investment Guarantee. I was quite excited when I heard that, but then disappointed because it's just another way of saying complicated depreciation. Is that a fair assessment?
I think you could call it acceleration of depreciation. So what it will allow all companies to do, or all business entities to do, is to immediately deduct 20% of the cost of any asset that they acquire, where the asset as a whole costs more than $20,000. So if you're running a business, you go out and buy a new car, you'll be allowed, which costs more than $20,000, so not a tiny car, but a reasonably sized car, as certain television shows may say. A reasonably sized car, you'll get to deduct 20% of the cost of that vehicle. It's not an additional 20% deduction. It's the first 20% of the cost of the vehicle, and then the remaining 80% of the cost of the vehicle goes into your depreciation schedule, and you depreciate it under the ordinary rules. So it accelerates some depreciation in effect.
And then comparing that to the instant asset write-off, which the current government tweaked in the recent budget.
Yes, so the instant asset write-off applies only to small business entities, so turnover of less than $50 million. It applies to assets costing less or up to $30,000, and it expires at the 30th of June 2020. So the instant asset write-off allows an immediate deduction for the whole cost of the asset where you meet those criteria. The Labor Party's policy, the Australian Investment Guarantee, is unlimited in its scope. As long as the asset costs more than $20,000, it's eligible for the scheme. You don't have to be a small business entity to be eligible for the scheme. It applies to all taxpayers, but it's only 20% of the cost of the asset.
And the instant asset write-off was passed, wasn't it?
The changes to the instant asset write-off have been passed, and the Labor Party, as we understand, doesn't intend to try and change that. So the instant asset write-off will still be there until the 30th of June 2020, irrespective of which party takes power after the election.
So the next topic is the Tax Transparency Code. And I note that it's affectionately known as the Voluntary Tax Transparency Code. How voluntary is it?
Well, at the moment it is voluntary. So it's a voluntary tax transparency code that allows companies, and it's aimed at companies, to sign up to disclose a whole lot of information about their tax policies and the amount of tax they pay in various jurisdictions. Currently it's voluntary. It has two levels of disclosure, a level of disclosure for those under $500 million in turnover, and then a different, more detailed level of disclosure for entities over $500 million in turnover. But it is voluntary. You can choose to sign up to it or not. If you want to see which companies have signed up to it, you can go to the Board of Tax website, and there you can see which companies have signed up. The Labor Party policy is to make the Voluntary Tax Transparency Code mandatory. So the V will be replaced with an M, and we'll end up with a tax transparency code that I think mandatory might be a better word for that, Tony. But yes, so a mandatory tax transparency code for taxpayers with a turnover of more than $250 million, so more than $250 million in turnover. And presumably there will be some anti-avoidance rules about aggregating turnovers of related entities. In that, you will mandatorily have to comply with the code.
And as we've seen in the past in some of these tax disclosures, they're fraught with peril because it's very difficult to get a clear line of sight on the tax position of companies for a whole range of reasons. They might have come out of losses. They may have certain, maybe receiving dividends and it's fully franked. And so it's quite misleading in some ways. And in the media, it gets portrayed in a certain way, but it doesn't necessarily disclose the full picture.
Yes, so I mean, I've had reason to look recently at Rio Tinto's tax transparency disclosures. Their tax transparency disclosures are a booklet that runs to 30-odd pages. Summarising that into a 10-second soundbite for the media means that you ignore a lot of the details. You ignore a lot of the details, and you just end up talking about the headline rates. And with all due respect to our audit partners, Tony, because you and I both respect them a lot.
Very healthy respect.
The accounting for companies is not sufficiently consistent that it's easy to compare apples with apples.
Yeah.
And so you end up with different messages having to be delivered.
And presumably those who are currently volunteering, they're doing so to project that they're good corporate citizens.
That's correct, yes. Yes, that's right.
Yeah. And those who are subject to the mandatory provisions will be named and shamed, as it were.
Well, I think it depends how it's implemented, but I would hope that it just becomes mandatory and people's reports are then disclosed. Typically, they're disclosed at the moment by a link which drives from the Board of Tax website into the company's own website, where they're encouraged to publish the transparency details. Now, making it mandatory tends to mean that you've got to lodge it somewhere and those sorts of things. We don't have any of that detail
hopefully
yet.
there can be some consistency in reporting as well. So, as you say, apples with apples. The next topic is R&D, and for several months we've had a lot of talk about R&D. It's been the ATO have been challenging heavily some previous claims for R&D, and then the current government has pulled back on the availability of R&D. What's the Labor Party position on that?
The Labor Party position before this morning, I would have said, was no change. So the Labor Party position was that they weren't intending to change the law as it currently stands, and they were actually, hearteningly, going to undertake an inquiry, not a formal Royal Commission or anything, but an inquiry into how Aussie Industry and the Tax Office have been administering the incentive, and with a view to seeing how harsh those two bodies have been on taxpayers. And in our view, they have been somewhat harsh over the last couple of years. As of this morning, media is reporting that the Labor Party intends to provide an increased level of R&D tax incentive for organisations that undertake collaborative research, so research in collaboration with universities or other academic institutions. So it'll be interesting to see the details of that. That's driven off some data which seems to show that organisations that undertake collaborative research with higher education bodies actually end up with a better outcome. They're more likely to actually succeed in their R&D efforts. So if that's the case, then that would be a welcome change to the law.
The institution would provide some more rigour in terms of the processes for research.
There are lies, damned lies, and statistics, Tony, but it's hard to know what to read into those results. But it would seem that is one possible explanation, certainly.
Well, thank you, Mark. That's the business items that we've selected. We might move through now to individuals, and there's a range of things in there. Starting with, we might start with personal tax. The opposition have seen to position themselves differently in terms of individual income tax, and the current government has announced a range of changes to the personal tax rates which stretch out
on the never, as you might say,
which is nice to be able to promise. But they've signalled an intent to lower personal tax rates, and the Labor Party have said that they want to adopt a different approach.
Yes, so the Labor Party are very much targeting any personal income tax relief at the lower end of the income spectrum. So broadly, they're supporting the government's position on the low and middle income earners tax offset, which disappointingly doesn't easily truncate into a three-letter acronym. But the low and middle income earners tax offset kicks in from the 30th of June 2019. So for lodgement of tax returns that is going to happen in respect to the current financial year, and is really targeted at people earning below about $70,000, so $70,000 and down. The other change to the personal income tax rates that the Labor Party has announced is an increase to the top marginal rate of tax. So a 2% increase to the top marginal rate of tax, which would take it, including Medicare levy, from 47% to 49%. So the same rate that was being paid up until 2 years ago under the budget repair levy. In essence, that's being re-implemented.
That's for a period of 4 years, is that right? That's what they've flagged?
They've certainly flagged that that's for a period of 4 years. It's difficult to predict what's going to happen next year, or indeed what you're going to have for lunch tomorrow. So at least 4 years. Presumably, if the budget situation improves markedly, then maybe that will be looked at again. If it fails to improve, maybe it'll continue for more than 4 years. But I think trying to predict any further than that in the future is unlikely to meet with much success.
And it's quite complex in terms of the differences between the two. wonder how the electorate's going to digest that and make a comparison.
I think it's going to be really difficult, particularly where for the current government's future tax breaks, we're talking about 2024, 25. That's a very long time in the future, and anyone who can predict what they might be earning then and how that might affect them is doing a whole lot better than I am, to be honest. It will be interesting for the electorate to digest. I suspect that there's a feeling in the electorate at the moment, if I were to summarise, to say the current government is offering personal tax cuts, but they're quite some distance away. The Labor Party is offering some tax cuts aimed at the low end of the income spectrum, and then increasing the top marginal rate of tax to 49% in the short term. That's probably as much as any normal human being could possibly understand about what's going on.
So the next item is quite significant in terms of the proposed changes to capital gains tax. We've had some, back since 19th of September 1985, when capital gains tax was introduced, we've had some concessions in terms of CGT, as it's known. This is a big departure from where it's been.
Yeah, it's a change from where it's been for the last 20 years, effectively. So since the year 2000, we've had this thing called the capital gains tax discount, where if you hold an asset for more than 12 months, the gain that you make when you sell the asset is halved before it gets put into your income tax. So to put that in percentage tax rate terms, that effectively means that someone on the top marginal rate of tax is paying tax on capital gains, again under the current scales, for where the top marginal rate is 47%, they're paying top marginal rate of tax on capital gains of 23.5%. The proposal is that for assets that are acquired from the 1st of January 2020, so it's not all assets, it's not existing assets, but any newly acquired assets from the 1st of January 2020, the discount will be reduced to 25%. So again, if you're looking at, well, what's the effective tax rate on capital gains, if we're thinking about a 49% top marginal rate of tax and a taxpayer in that bracket, and a 25% discount, then the effective rate of tax is 36.75% on the capital gain. Now, when you put it in those terms, and you think that a company pays tax at a flat rate of 30% on its capital gains, and distributions out of trusts to adult beneficiaries are taxed at a flat rate of 30%, this proposal, along with the change in the top marginal rate of tax and the change to the taxation of trusts, may make family investment companies a whole lot more attractive as long-term investment vehicles, which is somewhat ironic for me, because I spent the first 20 years of my career shutting down family investment companies as they slowly became less and less attractive, and suddenly we're turning the corner, and they seem to be more attractive again.
So it is a bit of a shift, and if you think back historically, when CGT first came in, there was sort of averaging type provisions and indexation, and the 50% rate was really about recognising those elements, but bringing a level of simplicity in terms of the calculation, which we're supposed to recognise that capital gains could accrue over a period of time, and to tax them in one lump in a year perhaps gave some distortion in terms of the taxing impact. That seems to be out the window.
Look, I think that's right. I think the rate of tax on capital gains, or the reasons behind the discount, and as you say, the previous system, which had averaging and indexation in it, has sort of been lost in the murky mists of history a little bit. The discount, or the level of discount, or the level of tax rate, is really now just becoming a bit of a commercial negotiation about a number. Having said that, we are in a relatively low inflation environment at the moment, and so there might be some, the Labor Party may claim some justification for reducing the rate of discount on that basis.
Thank you. So the next item, anyone who's tuning in is probably terrified by the fact that we've put in their estate taxes, but we've only raised that because it's been in the press as being something that there's a suggestion that the Labor Party are going to introduce a estate or a death tax. Now, nothing that we've seen would suggest that, and I don't know whether you, through the circles you move in, have heard anything along those lines.
I've heard nothing about it, Tony. I think the Labor Party has specifically said they're not interested in introducing estate taxes. And if I were to really play devil's advocate, there already are, in effect, estate taxes in the Australian tax system. They're just not called that. So there are taxes on distributions of monies out of superannuation funds to beneficiaries on death. There are also the capital gains tax system, whilst death does not trigger a capital gains tax event. The fact that estates are often turned into cash for distribution means that death often brings assets into the capital gains tax net at that point. So whilst there are no estate taxes, the Labor Party has specifically said they're not interested in introducing estate taxes. There should be no change here.
Right?
Yes, correct. It's a policy of the Greens.
Okay. Thank you. Rest easy, everybody, for now. So the next item, again, this has received a lot of press for probably 12 months or so, because Chris Bowen announced this some time ago, and that's the changes to negative gearing.
So it has been some time. This policy was actually taken to the 2016 election by the Labor Party. So it's been floating around for a while. In its current formulation, what this is going to do is to deny deductions for negative gearing, or in essence, negative gearing is a misleading term. It's going to deny deductions for losses made on investment portfolios for in respect of assets acquired from the 1st of January 2020. So
when you say investment portfolios, that includes shares. I mean, most of the discussion has been around property, but this goes beyond that.
This goes beyond that. So as we understand from the policy announcements, the restrictions are going to be on all passive investments. So whether they are real estate, which is where we normally talk about negative gearing, we talk about negatively geared residences, but the proposals, as we understand them, will also apply to losses made on real estate which is not residential, so commercial real estate or retail real estate, and also to other passively held assets, so share portfolios and so forth. As I say, only applies from the 1st of January 2020 to assets acquired on or after the 1st of January 2020. And importantly, there's a carve out for acquisitions of newly constructed residential property after that date. So you continue to be able to claim your losses in respect of newly constructed residential property at any time.
Have they articulated why they carved that out? Was that just to stop the dampening of the construction sector?
Yes. So in essence, this policy probably had its origination, although it's moved well beyond that, in the affordable housing discussion. And what is intended is to, in two ways, and whether this will happen or not, I can't really comment on. I'm not an economist, but the thinking around this is this will hopefully, well, when it was first proposed in 2016, dampen the increases in prices of residential property by making paying more and more on the basis that you can get a deduction for your interest on that loan or for a loss on the property, for making that loss not tax deductible anymore. So it might stop people just paying more and more, but also not to apply the rule to newly constructed housing, so there's not an impact on new supply. And the idea is to encourage the production of new supply. Now, whether any of that will happen, the impact on house prices and the impact on rental costs, that's all quite up in the air. There are second and third order effects there that I don't think that you can look at the taxation policies in isolation from the rest of the economy, from supply and demand, from regional factors. There will be different answers all across the country.
But someone who's choosing to go into the property market and is going to borrow to do so as an investment might be drawn to new property as opposed to secondary property. Therefore, that could have an impact on that market.
It could. It absolutely could. The other thing to think about here is that, as we understand from the policy announcement, although I must say it's not terribly clear, is that the negative gearing or the investment asset loss provisions will apply on a portfolio basis. So it won't look at property by property or share by share. It will actually look at the whole of a taxpayer's investment portfolio as to whether there's a loss overall or not.
So on that, the poor person who's got a share portfolio with a margin loan, who's got dividend reinvestment shares,
you should expect to have a very difficult calculation to do each year. That will be quite difficult because of the need to trace that margin loan to a constantly changing share portfolio and work out how much of the interest relates to assets acquired on or after the 1st of January 2020 versus those that relate to the pre-existing assets.
Very complicated. And then you combine that with a limit on the deductibility of accounting fees. We're in for some interesting times. So the next point, which again has been highly controversial and continues to be so, is the changes to dividend imputation. And this is impacting everybody from pensioners through to super funds through to individuals.
So the proposed change is to deny a refund for excess imputation credits. So at the moment, if you receive a fully franked dividend from a company, so you might receive a $70 cash dividend with a $30 franking credit attached. When you receive that income, what actually goes into your individual tax return is $100 of income, because both the cash dividend and the franking credit are treated as your income. So if you receive that $70 dividend, Tony, you would include $100 in your assessable income. You then work out your tax payable on that, and that would depend upon how much other income you had and what marginal tax rate you're at. So if you're on the top marginal rate of tax, and at the moment you're paying $47, you'd calculate $100 at 47% is $47 worth of tax. You then get to take off the imputation credit that you've been sent. So $47 minus 30 leaves $17 of tax for you to pay. If, however, you weren't working, you had no other income, that $100 was the only amount of assessable income that you had, so you're under the tax-free threshold, which at the moment is $18,200, you have no tax payable. So the $100 is in your income, sure, but your marginal tax rate's zero. You got no tax payable. As the law currently stands, the $30 imputation credit is refundable to you. So you'll get a check back from the tax office in those circumstances for $30. The proposal from the Labor Party is to remove that refundability. So franking credits, imputation credits, can reduce tax payable to zero, but they can't make it a negative number. They can't make it into a refund. So that's really the proposal. Proposed to apply from the 2020 financial year, so for dividends received on or after the 1st of July 2019. And the only carve out for individuals is anyone who is on a government pension will still be able to get refunds of excess imputation credits. Everybody else will not be able to.
It's quite a harsh impact for people who've planned their retirements and built their portfolios around that particular element of their, particularly with Australian shares, because it's all contributes to the return they get on their investments.
That's correct, and that is the difficulty with any change to the tax laws, which makes something refundable or not refundable, or those sorts of things. Even if it's prospective, people have planned what they're doing, and it's very difficult for someone who has retired on the basis of their current investment portfolio to change what's happening. So yeah, that will be the big impact here, I would think. The other impact is that many companies are actually doing whatever they can to get dividends out on or before the 30th of June this year, to give their shareholders the best opportunity to claim refunds. Now, that's not a blanket solution, of course, because if people are in the current year in the top marginal rate of tax, all you end up doing is paying more tax. So that's not necessarily the smartest way to go in all circumstances, but depending on who your shareholders are and what their marginal rates are, it might be worth private companies considering what dividends they're going to pay before the 30th of June this year.
And it seems to come from a philosophical point of view. Originally, when imputation came in back in the 80s, under Paul Keating and Bob Hawke, it was intended to stop the double taxation of dividends, which was occurring at the time. You'd receive a dividend, the company paid tax, and you'd pay tax again, and the effective tax rate was up in the 60% mark, as I recall. So the question is whether it's a flow through, so that the tax rate of the dividend is really subject to the recipient, so whatever the tax rate is, or is it at a 30% rate, and that's all?
Correct. And to put that another way, the question is, if income's earned by a company and it's taxed at 30%, can the tax rate on that income ever drop below 30%? Should it be the marginal rate of the shareholder, or should it be the marginal rate of the shareholder, but with a floor on it of 30%? And as you say, that's a philosophical discussion. I can see both sides of that argument, to be perfectly honest.
So we might hold that theme and move through to superannuation and keep talking about franking credits, because there's a little distinction here as well.
There is. So superannuation funds, which are normally taxed at 15%, so they have an effective tax rate lower than the corporate rate of tax. So superannuation funds have been able to get franking credit refunds up to date. This is particularly evident for superannuation funds in what's called pension mode, where the fund actually pays no tax, so its effective rate of tax is 0, but it's still able to get refunds of franking credits. So the stopping of refundability to superannuation funds applies to them as well from the 2020 year under the proposals. There's a slight nuance here in that for an individual, if an individual receives a government pension in the year in which they receive the dividend, the prohibition on refunds of franking credits is removed. For a superannuation fund, a similar rule applies, but it's slightly different. The superannuation fund is still allowed a refund on franking credits if they had a member who was receiving a government pension on the 28th of March 2018. So anyone who's become subject to or got onto a government pension after that date, that rule won't apply. So there's a definite date for the superannuation funds. There's no such definite date for individuals. What this is probably going to cause, or the lack of refundability of franking credits, is probably going to cause some changes in investment decisions within superannuation funds and potentially in individuals' own names as well. Because if you have a 0 rate of tax, then the franking credit on a dividend is really just part of the investment return. So if that is removed, if that ability to get that refund is removed, the investment return on Australian shares is dropped. So that may cause a change in investment decisions.
Thank you. Again, people have tailored their portfolios to contemplate those returns, and it's going to be a bit of a shift, and there'll be a lot of rethinking of those things. Lots of different strategies, and I hear even people talking about removing amounts from funds and investing in their own names to get the benefit of the credits against other income and all sorts of things. So
yes, and particularly for self-managed superannuation funds, where self-managed superannuation funds have significant investments in Australian equities, even rolling out of self-managed funds back into large APRA regulated funds, because the advantage large APRA regulated funds have is they have a big stream of other income from member contributions from those who are still actively contributing. So they can use those franking credits. They don't ever get to a refundable point, so there's no prohibition on that refund. And then the benefit of those franking credits can be passed back to the members who have created them. So there's a whole lot of things to think about there if this proposal gets through.
And Mark, no surprises, there's yet another change to the non-concessional contributions cap.
Yes, so if only it weren't, because it's the superannuation system is supposed to provide stability so people know what they're doing in saving for their retirement. Unfortunately, no government of any persuasion has ever found itself in a position where it's prepared to leave it alone. The non-concessional contributions cap, so this is not the deductible contributions that are made either by your employer or by yourself. This is the limit on after-tax contributions that you can put in for yourself. At the moment, the limit is $100,000. The Labor Party policy is to reduce that to $75,000 a year. Now, in circumstances where the policy around superannuation seems to be on a limitation of the maximum amount of benefit that you can have, the $1.6 million transfer balance cap and so forth, where that's the policy, what the rationale for reducing the amount that can be put into superannuation out of after-tax dollars, so out of my own savings, I find that really hard, because once I get to the $1.6 million cap, I can't make any more non-concessional contributions anyway. So does it really matter to the government whether I get there, faster or slower? If I'm going to get there, I'm presumably going to get there. Anyway, there seems to be, what I'm saying in a long-winded way, Tony, is that there's no policy rationale for that reduction. It just seems to make the system more complex.
Yeah, and it doesn't make a lot of sense in the context of the fact that your ability to contribute to super has been substantially dampened in the last sort of 5 to 10 years. So younger people have really got to have the ability later in life to accelerate their contributions, because the mortgages and kids and all those sorts of things consume a lot of after-tax dollars. So there's a bit of catch up, and it used to be you could get $100,000 deductible many years ago, good old days.
You are living in the past, Tony.
I am living in the past. So it's going to be really hard for people to even get to the 1.6 if they keep pulling back the threshold caps. So
you're right, and it's not a change in the threshold cap for concessional contributions, but one of the other Labor Party policies, which also I think has no real basis in any policy, it's just a change, is around the concessional contribution cap, so the $25,000 deductible. Now, as of, it was only in July 2017 that was changed, so that people who are employed, so they have income from salary and wages, could actually top up that $25,000, claim a deduction in their own name. Because previous to that, if you had 10% or more of your income, so it's not even much of your income, but 10% or more of your income paid as salary or wages, you couldn't claim a deduction in your own name. There was no policy reason for that at the time. It's just how it was. That was changed from July 2017. That, I think, was a good move, because it's saying it doesn't matter where you get your income from or how you put those deductible amounts into superannuation. The limit for everybody is $25,000 a year. That makes sense. The Labor Party is planning on repealing that July 2017 change. So somebody who is in receipt of salary and wages income, which is more than 10% of their income, can no longer make deductible superannuation contributions.
What about salary sacrifice?
Salary sacrifice is fine, because it's going in from your employer. Correct, but not every employer offers salary sacrifice. And what about the modern economy, where people have side hustles and they might only want to work part-time for an employer but have a business of their own? Suddenly we're putting them in a position where they can't make deductible superannuation contributions out of their business income. It's ridiculous.
Doesn't seem to be a logic thread to that policy.
There is a nice way of putting that is there is no basis in policy for those changes.
And then the other sting is in terms of the Division 293 tax, which is on high income earners and their concessional contributions.
Yes, and I keep telling the government of all persuasions they need to find a better name for that than Division 293 tax. But this is the additional 15% tax on concessional superannuation contributions for high income earners. And the Labor Party is effectively changing the definition of a high income earner for the purposes of that tax, from someone who earns $250,000 a year down to someone who earns $200,000 a year. So that's inclusive of superannuation, by the way. So that's not just your salary or your business income. That's also inclusive of the superannuation contributions. So pulling that threshold back to $200,000 is going to bring a lot more people into the system.
So more in the net. And then finally on superannuation, borrowing by self-managed super funds is going to be prohibited?
Yes, so superannuation funds traditionally were never allowed to borrow. Probably 10 or 15 years ago, the government introduced the concept of limited recourse borrowing arrangements, LRBAs, which allowed superannuation funds to borrow to buy assets in certain circumstances. The Labor Party, it's fair to say, is not necessarily happy with that, and they're going to prospectively prevent self-managed funds from borrowing under limited recourse borrowing arrangements.
So thank you, Mark. We've covered the areas we wanted to cover, and we've got time for questions now if anyone wants to shoot any through. I'm going to be provocative and ask one up front. There's been a lot of discussion during the election campaign, and actually it's by both sides of politics, about the top end of town. Now, my question is two-pronged. Will there be a definition in the income tax about the top end of town, firstly? And secondly, have you been there and what's it like?
Well, Tony, I think it's fair to say I haven't been there as far as I'm aware. I walk up to North Quay every now and again here in Brisbane, which the legal fraternity would call the top end of town because it's closer and closer to the courts building as you go up that direction. The problem with Australian politics is that everything is being dumbed down into 3 or 10-second sound bites. And so the top end of town sounds great. The problem is there are so many definitions and so many thresholds in the Act. So anyone in their right mind, and I don't count myself amongst those, I'm professionally required to follow them, but anyone in their right mind who doesn't follow tax on a daily basis, it's not a surprise they get confused because there are so many thresholds in the Act. There are about 4 different thresholds for what constitutes small business, frankly. That's ridiculous. So do I want a definition of top end of town in the Act? No, because I don't know exactly what anyone means by that. It sounds like a lovely throwaway line. Interestingly, the Labor Party, for all its comments about the top end of town, a large number of these changes are not solely going to affect the top end of town. There are some that I can think of that will. So the thin capitalisation changes are pretty much going to affect multinational enterprises. You've got to be in the thin capitalisation regime, you've got to have at least $2 million of interest deductions. That's a lot of borrowing these days at the current interest rate. So you've got to be a fairly substantial business. The announcement they made a couple of days ago about royalties to tax havens, yep, that's going to affect large multinational enterprises. They can afford to look after themselves. But the vast majority of the things we've spoken about today are not affecting businesses or organisations of that size. And indeed, a number of the things we're talking about today are not even affecting multimillionaires earning, millions and millions of dollars in income a year. The minimum 30% tax rate on trusts, the changes to the superannuation contribution thresholds, all those sorts of things, the refundability of franking credits, they're going to affect a lot of people. And they're going to affect a lot of people who are not, by any stretch of the imagination, extremely well off. So I think I would really call on all sides of politics to stop demonising the top end of town. I'd really like it if they stopped demonising the tax profession as well, but that's probably pie in the sky. But stop demonising the top end of town and start talking about what is the mischief that you really want to affect. And let's have an honest conversation about that, as opposed to a 3-second soundbite that looks good on the news and hopefully you think appeals to your base.
Well, thanks, Mark. It was a throwaway line. We might throw it back for what it's worth. Look, thank you for that comprehensive coverage. I think we're sort of 10 days out from the election. It's going to be quite fascinating to see how it unfolds, but we'll be back with some more of these webinars as some of these become a reality or whether they're consigned to the dustbins of politics, that remains to be seen. So thanks for your time. Thanks everyone for joining us today, and we'll talk to you next time.
Thank you, Tony.